Your paycheck hits your account on the 1st of the month. Your rent or loan EMIs aren't due until the 5th. For those 5 days, that cash sits idle. At the exact same time, the actual cost of living is rising by 6 to 10% every year. Your bank's yield is instantly consumed by inflation. This graph shows the reality. You have the flat blue line of a 3% savings yield, utterly overshadowed by the steeply rising red line of real-world inflation. Leaving your cash here is a mathematically guaranteed loss. Looking at the projection here, we can apply the rule of 70 to measure the damage. Divide the number 70 by a 7% inflation rate, and you get exactly 10 years. In 1 decade, an idle balance of 1 lakh rupees shrinks by 50% in actual purchasing power. Traditional savings accounts don't preserve your wealth. They execute a slow, silent drain on your cash. The standard reflex is to open a short-term fixed deposit. If you lock up cash for 7 to 45 days, an FD will give you an annualized rate of around 3%. You are earning fractions of a penny. You also cannot park rent money in the stock market. The volatility risk is entirely unacceptable for cash you need to spend next Tuesday. The practical fix lies in a specific category of debt mutual funds, namely overnight, liquid, and money market funds. These funds aggregate retail cash and lend it directly to the government and top-tier corporations for very brief periods. In exchange, they return institutional-level yields of 6 to 7.5% to you. To capture that extra yield, you have to make a calculated trade. You give up the absolute frictionlessness of a bank ATM, and you accept a system of structured liquidity. Let's address cash that only needs to sit idle for 1 to 7 days. The exact tool for this timeline is the overnight fund. The fund lends your money out for exactly 1 day, fully backed by government or highly rated corporate bonds. Because the duration is literally a single night and backed by collateral, the credit risk is virtually zero. The loan cycles every single day, returning an annualized yield of roughly 6.5%. Your balance ticks upward daily. This decision tree outlines your first pathway. For a 1 to 7 day horizon, overnight funds deliver a 6.5% yield. But notice the penalty, T+1 settlement. You cannot swipe a debit card to get this money. Bulk withdrawals require 1 full business day to process and land back in your account. Overnight funds are perfect for salary layovers, provided you account for the calendar. Money requested on a Sunday won't arrive until Monday. Next is the cash waiting a few weeks to 3 months, money earmarked for upcoming quarterly school fees or a dedicated emergency buffer. Here you use liquid funds. These vehicles hold debt instruments that mature in under 91 days. By extending the loan duration slightly, your annualized yield bumps up to approximately 7%. Expanding our map, you see the liquid fund option. You capture a 7% yield, but trigger a penalty, the 7-day exit load. Withdraw before 7 days, and the fund imposes a fee that actively eats into the returns you generated. Liquid funds enforce patience. You only deploy this tool when you are absolutely certain that cash will remain untouched for at least a week. Finally, we have lump sums waiting 3 to 6 months to be deployed. Think of a house down payment or a seasonal business capital injection. This requires money market funds, which invest in securities maturing in up to 1 year. This yields 7.5% or higher. You capture the best safe rate without getting trapped in the rigid lock-in periods of a fixed deposit. The final branch of our map details the 3 to 6 month window. You get the highest yield from money market funds, but the penalty is rigid, 0 instant liquidity. There are no emergency withdrawal features here. Every single request is processed on that T+1 timeline. Also note that because these loans stretch out closer to a year, the daily return rate is more sensitive to broad interest rate adjustments from the central bank. Money market funds beat a short-term FD, but demand absolute discipline over your payment calendar. The fund you choose matters, but the platform you use to buy it dictates how fast you can hit the panic button. A standard DMAT account gives you a clean, unified view of your portfolio, but it strictly locks all your mutual fund withdrawals into that T+1 delay. If you buy direct from the asset management company or through non-DMAT platforms like Smallcase, you activate a crucial lifeline, the ability to instantly withdraw 50,000 rupees from overnight and liquid funds in under 20 minutes. Looking at this comparison graphic, the trade-off is obvious. Prioritizing a demat broker for a pretty dashboard actively removes your access to emergency instant cash. A unified interface isn't worth losing a 50,000 rupee instant withdrawal option when an emergency actually hits. Let's map your exact profile. If you are a salaried balancer with a 5-day gap between getting paid and paying rent, route that cash into an overnight fund. If you are a lump sum holder sitting on cash from a property sale, park it in liquid or money market funds while you search for your next asset. If you are a business operator holding a buffer for incoming GST bills or a massive vendor payout next month, map your payouts meticulously. This matrix maps the exact fund to your profile, highlighting rules you must respect. If you fall into the business operator category, mark this warning. A Friday crisis means no T+1 cash until Monday. Plan your vendor payments accordingly. Earning these yields relies entirely on identifying exactly how long you can hold the cash and respecting the settlement rulebook of the vehicle you chose. A traditional bank account creates an illusion of complete safety, while mathematically draining your wealth through inflation. Setting up a new platform just to park cash for 2 weeks feels like a hassle. It requires mental friction. You have to weigh that temporary friction of setting up an account against the permanent compounding loss of your money sitting idle. Protecting your purchasing power doesn't require a masterclass in finance. It simply requires you to plan your outflows. You generate a higher yield on your idle cash without taking on market risk. You do it by trading the instant convenience of an ATM for the discipline of cash flow management.